Well, welcome to this month's investment strategy brief. Here we are in September, and we're going to focus a little bit on, number one, a COVID-19 update, and then number two, the election, the 2020 election that's coming up. So let's jump right in, starting with a COVID-19 update. So to sort of anchor ourselves in things that we've known through the beginning and into this pandemic, we know that the shutdown around the country and around the world was really about slowing the spread, kind of making sure we didn't overly impact the healthcare system. So we've all been living that and figuring out how to live with COVID-19. And then a number of months ago now, the federal government sort of framed out an approach to reopening. The spirit of it was to look for improvement sort of in 2-week intervals and then take some steps. And we all know in today's world that's a much more complicated thing, meaning that each state, sometimes county, is setting up their own criteria, and things are ebbing and flowing as the virus presents itself. And in fact, if we look at the pattern of the virus, this is a chart just showing basically daily cases. It's a 7-day average to avoid sort of the cyclicality that we see through any particular week. But basically the bottom line is that we've been on a pretty good trend through the summer. You can see a bit of a blip recently, really in the wake of Labor Day, and then it's calmed down. But the big sort of speculation and expectation is as the weather turns, we're into fall. Think of it almost like the seasonal flu, that as people have to be indoors a little bit more, we're going to see a kick up in cases. And then, of course, another metric, unfortunately, is looking at mortality. Here's deaths, and we can see a similar trend where there's been, fortunately, a big decline, and what we're waiting for is whether we're going to see kind of a resurgence. So one thing that people are watching very carefully is whether we'll see basically an increased outbreak with the weather. But the other pattern that's been observed is that as things get better and people feel comfortable, they start taking more risks. And when they do that, then that basically spreads the virus, so then it shows up again. So that's a pattern that we're sort of living through until we get to a vaccine. So here's our tracker for sort of both therapeutics and vaccine. And I think the main takeaway here is that we're expecting some news in the fourth quarter. So, for example, I think it's Pfizer indicating that they may announce good results on their phase 3 testing in October. And the idea with that then is should we see sort of improvement in terms of making the vaccine available this year and into 2021. So everybody's watching that. And as we've said before, we think the market, to some degree, investors are pricing in the expectation of a vaccine. We know that the federal government, both the Fed and then Congress and the White House, implemented unprecedented policy response to the pandemic. And what's in play right now as we're looking towards the election is really almost gridlocked negotiation going on between the Senate and the White House, who are sort of, have a view between $500 billion and $1.5 trillion, call it, in terms of a package, and the House Democrats holding firm at a over $2 trillion package. And so this, we think, will continue to be negotiated, and the sort of the messaging around the negotiation is frankly all part of the sort of the various campaigns going on for the election. So again, more to come as it relates to further policy response. And then looking at mobility, we've looked at these trends before, and things are kind of continuing as we've seen them. Parks and recreation is way up. The idea of going to work, transit, and workplaces, basically flatlining about round numbers, about 40% below normal levels. But the patterns that we're seeing all make sense. We're sort of in a little bit of a holding pattern, kind of waiting for a vaccine. Now, we've talked a lot as it relates to the pandemic and the shutdown about recovery, and we've used this slide many times to kind of wonder about the shape of recovery. But recently we published on the shape of recovery. And so this next chart basically shows a bunch of graphs. Think of this as different data where we're presenting it for a year to literally be able to look at the physical shape of the recovery. So we have housing, things like housing sales, home sales, and building permits. We have business sentiment, so business optimism and outlook type data, which really are captured in the Purchasing Managers Indexes, or PMIs. On the business side, more directly, we have truck shipments, CapEx spending, factory orders, and then the consumer, retail sales, and confidence. And generally speaking, for business and housing, we're seeing a full V-shaped recovery. For the consumer, things are on their way back, so think retail sales, but there's a little bit more to go. And then interestingly, and we'll get into this in a minute, as it relates to confidence, the consumer is a little bit worried, basically, and we think it's related not only to coronavirus but also to the election. So we'll get into that. Anyway, the 4 key measures that this is reading is these are all things that generally haven't fully recovered, or 3 or 4 of them haven't. Unemployment, or the employment environment. So here, as measured by unemployment, you can see it went way up and it is recovering, but not yet back near pre-pandemic levels. GDP, which is really hit hard in the second quarter with a forecast of recovery into the second half of this year and a full recovery into 2021. The stock market has recovered, and then it's been hovering around that sort of pre-pandemic level with a bit of volatility. And then finally, earnings. We'll talk about details of this in a moment, but the idea that earnings have been hit and they are expected to recover into next year. Now let's turn to the 2020 election. What we want to do is frame a few things in terms of what we see going on and then what this might mean for the markets. So first, as it relates to the year that we're in, it's a presidential election. Of course, the House seats are all up for grabs, and then some subset of the Senate. This chart is almost like a math chart where we're presenting all the possible combinations that could occur in terms of power. Who takes the presidency, who takes control of the Senate, who takes control of the House, with the status quo sort of circled there within the divided government section. And the bottom line is, right now, and we're going to look at this a little bit, there's a possibility of a Democratic sweep, maybe a lower chance of a Republican sweep. We've got the status quo, maybe Congress doesn't change, but Biden wins the presidency. There are all kinds of different combinations. And so it's important as we're doing our work to try to size the likelihood of each and the implications of each. And we'll get into that in a sec here. Now, let's take a pause and take a look at what is important to people. So this chart on the left basically shows for Democrats and Republicans, or in this case, sort of Biden and Trump supporters, which things are most important. And really, when you look at it, flipping the different measures, right at the top of the list are the economy and healthcare. And then further, when people are polled, well, which of these 2 candidates will do a better job? Who do you trust more as it relates to handling the economy or healthcare? Same thing, it's kind of flipped. So people basically trust Trump a little bit more on the economy. And at present, at least, they trust Joe Biden as it relates to healthcare. This, to me, says it's one sort of illustration that things are not quite 50-50, but it's still a little bit of a toss-up. And again, we'll get into the numbers. So here's an example of that, basically betting odds at the top of the page and then polls. And you can see for a period of time that, essentially what we're seeing is Biden having a modest edge. And then when we look at polls, he's running about 6.5 points ahead of Trump. This is a September 21st national poll. When we look back to the last presidential election, a similar pattern, but not the same magnitude. So Clinton had a couple-point lead against Trump back 4 years ago to the day of that national poll. So again, what we're seeing here is that the race is very tight. By polling and betting odds, Biden is showing a modest sort of a benefit that modestly it looks like he could win, but the numbers are very, very close to one another. It's by no means locked. Now, here's another super interesting example where what's charted here is basically favorability. So this is gross favorable rating. What percent are favoring the president in this case? And then what was the vote in these past elections? Think of it as a 2-party vote, just counting Democrats and Republicans. And basically what we're seeing here is that you can see a pretty firm line in terms of the relationship between those 2 things, and that what we've painted in is basically Trump's current gross approval rating. And essentially what you see when you bring it up to the line is that it projects just barely that he could lose the election. Now, super close to the line, so it's right on the edge. Now, the other thing that's super interesting, and I don't think this is a surprise because people are very emotional about President Trump. When we look at net favorability ratings, so this is sort of how much they are favored, just think of it as the favored percentage less the unfavored or plus the unfavored percentage. So a positive numbers mean, that overall people are favoring. A highly negative number means that there's sort of more people that are not favoring the particular candidate. And you can see here that by the sort of the readings from Trump versus Biden today, Obama versus Romney, as another example, essentially Trump's number, this net number, is very negative. And again, I don't think it's a surprise because people are very emotional when it comes to the president. So here is a couple exhibits that kind of give us a feel for what's going on with the White House and Congress and just how close the races are. So the chart on the left is basically a map where we've painted in red for every state where it looks like Trump has it locked up, blue for every state where Biden has it locked up, green where we think this is a traditional battleground state and where it's super important this year, and then gray where it's unsure at this point. And what this really tells us is that when it comes to sort of, capturing all the votes, it really is a bit of a toss-up. Now, I will point out that when we look at the polls across the gray states and the battleground states, on average, Biden is leading just a little bit. And so, again, the numbers lean his way as it relates to polling. Now, when we look at Congress, and we've talked about this before, in the Senate, where the Republicans have a modest 3% edge, they have more seats up for re-election. So the Democrats, in theory, have a higher chance of grabbing more seats because there's more elections going on. So that's something we'll be all watching very carefully. In the House, while the numbers are bigger in general, it's just over a 3% edge for the Democrats. So in this case, of course, all those seats are going to be recontested in this election, and we'll see where it goes. I think the view is that the House will be controlled by the Democrats when this election is over, but all the seats are up for grabs, so we'll see. Now let's look at a little bit about their platforms. And here we have a chart that basically sort of ranks across different topics where the two candidates are relatively similar and where they're different. And so if we look at the bottom, for example, whether it's government spending for different reasons, both would, on average, be expected to increase government spending. As it relates to the relationship with China, obviously President Trump has been of a view of being tough on China, and Biden is sort of signaling a similar view. When we get to regulation, that's where things start to differ a bit. So we expect, on average, for Trump to be favoring deregulation, as he did in his first term in office, and Biden is generally favoring increased regulation. And there's a big focus on big companies, especially big tech, and whether anything's going to get broken up. As it relates to foreign policy, think trade. Trump, in general, has tried to sort of pick off counterparties and negotiate individual bilateral agreements. Biden is sort of used to the more traditional approach of a multilateral agreement structure, so we'll see where that goes. Healthcare, obviously significant differences in their views, where Biden is leaning towards sort of expanding Obamacare, so the Affordable Care Act, and sort of more government support for healthcare. Trump obviously is in favor of sort of more private market approaches to healthcare. Environment, I think this is pretty obvious, where Biden comes with a sort of a party that's very interested in clean energy and sort of combating climate change, and the Republicans just less so. And then finally, taxes. We should expect, if Biden wins, that there's going to be an increase in taxes kind of across the board. And again, as we get into further into the period before and after the election, that'll be in keen focus. Now, as it relates to sort of the ultimate impact, this is a sort of a chart from a publication that we did. So if you have the deck in front of you as well, you can hit on that title. It's actually linked to the full report. But what we wanted to do is look at not only if Biden wins or Trump wins, but also split governments. What do we expect? And so let's just kind of walk through it at a high level. And with regard to the economy, basically with a sweep of the government, so either a Democratic or Republican sweep, Interestingly, we think incrementally that that's a positive for the economy for different reasons. If there's a Republican sweep, again, a lower probability outcome in this case, then basically the economy can grow a little bit faster from private spending. So think of it as the idea being, okay, lower taxes, deregulate a little bit more, kind of stoke the engine a little bit more on the private side. In the case of Democrats, it would move more to public spending. So the government's spending is a part of what we measure in the economy. And so if Biden wins and there's a Democratic sweep, with Congress going to Democrats as well, then we would expect public spending. So those two tails, those sweeps, we would expect to be incrementally positive for the economy. On the equity markets, and again, this is relative to what we think today, we kind of think of a government that is split as neutral. That's the status quo. That's where we are today. If we see a Republican sweep incrementally, that's probably positive for the markets. And if we see a Democratic sweep, that's probably incrementally negative. Then finally, when we look at within equities at sectors, you can imagine if there's a Republican sweep, we'd be thinking things like aerospace, defense. Democratic sweep, maybe industrials, materials, renewable energy. And then finally, with interest rates, again, those two sweep scenarios are probably leading to slightly higher interest rates, in part because of the sort of faster growing economy. So inflation will probably go up a little bit. That will bring rates up a little bit. Now, another interesting thing to look at is uncertainty. So when we track and look at uncertainty, there's indexes that track this. Basically, one thing we see that's super interesting is that when uncertainty spikes, and you can see this chart on the bottom of page 21 here is choppy. When it spikes above 200, and then we measure forward the return of the equity market, basically in the wake of uncertainty, equities tend to do well. And really that's driven, usually the philosophy or view of it is uncertainty is declining, things are becoming less worrisome, and that's good for stocks. And coincidentally, going into election, uncertainty tends to go up. Now, in this environment, we've got the election and people wondering about the outcome of the election, but we also, of course, have coronavirus and wondering when we're going to have a vaccine, et cetera. So uncertainty is high. To the degree it comes down as a result of the election, especially if it comes down as it relates to knowing more about a vaccine, as an example, we would expect markets to post positive returns as a result. Now, another thing that we took a look at was how do equity markets do sort of going into and out of the election, and how does that relate, if it does, to kind of who has control of government. So we kind of modeled three: a Democratic sweep, a Republican sweep, and a divided government. And what you look at here is before the election, basically the markets are happiest if we're headed towards a divided government. So you can see, 6 months before, a good positive return, 3 months before, a little over 1%. And then it's sort of muted but growing after that. So after the election, 2.4% for the next 3 months, and then totaling 5.3% for 6 months. What's interesting is that when you look at a Democratic sweep, that's usually preceded by a slightly weak market and then sort of the lowest returns going forward. And that's probably the market, again, on average, reacting to maybe a little bit more regulation, that kind of thing. And then with a Republican sweep, basically that leads to, in the subsequent 6 months, sort of the strongest results, which, again, I think in terms of policy and plans, what people do, that is, logical. Anyway, as it relates to where we are today, we're sort of halfway through the 3-month period before the election, and the market's down about 0.5%. But when we look over the period that would conclude at 6 months into the election, we're actually up around 15%. But of course, that's really recovery from coronavirus. So all this data, for what it's worth, is a little bit sort of suspect in this environment, given coronavirus and the pandemic. Now, longer term, one of the kind of key takeaways is, for all that we do to analyze what's happening going into and in the wake of an election, really at the end of the day, markets are pretty resilient and it doesn't matter that much. So this chart shows us, number one, this goes back a long time to the 1930s. It happens to be the Dow Jones Industrial Average. Basically, whoever's in the White House doesn't really matter. About 9%, a little over 9% being the average annual return for administrations. When we see a divided government, the market is just modestly happier, at least defined by this index. So looking at a 10% annualized return, but a unified government, basically still good, a little over 8%. But not quite as good as a divided government. So interesting statistics. For all that we're doing, this is saying on average the market goes up regardless of the makeup of the federal government. Now let's turn to the macro environment. Here on page 25 is our traditional 3-column chart, and we sort of highlight all the different things we're focused on. I'll just reiterate a couple things here. Obviously, in the current environment, a key focus is the election, what's going on with the election. And then secondly, and probably even equally or more important, is sort of the coronavirus and the recovery from coronavirus. So obviously, the headwinds this year have been all about the pandemic and the shutdown, maybe incremental worries about maybe increased regulation if Biden wins or things like that. But in general, it's been really defined by coronavirus. And then correspondingly, the tailwinds have been about sort of the recovery we're going through and honestly the hope for a vaccine. So obviously a lot to dig into, but at the high level, that's really what we're concluding. Now, as a part of the macro analysis we've created, as you'll recall, a coronavirus dashboard. And the idea was to look at a variety of measures and look for recovery. Every time you see a green upper arrow, that means that data point has recovered since over this period from the pre-pandemic levels, or back to those levels. But a couple things to note. So we see retail sales have recovered some, but there's still a little more room to go. Unemployment or employment, same thing. There's obviously room to go there, much more to go. As we look at GDP, we expect somewhere between a 4 to 5% decline in U.S. GDP for 2020. And then as it relates to survey information, basically I mentioned this, consumer confidence is weaker than one might expect during the pandemic recovery. And we think, again, it's attributable to that uncertainty about the election and people being kind of nervous about the vaccine in general. When you look at PMIs, there's more the survey-based data for businesses. Those have basically fully recovered. And many of these data points overall are back to pre-pandemic levels. Now on to the next chart, the second half of the coronavirus dashboard. Obviously, we're tracking coronavirus in general, as we talked about a couple minutes ago. But here are the markets too. Basically, we've talked about this. The S&P 500, for example, is fully recovered. It's been volatile recently. It should be volatile further into the election and maybe just past the election. But again, things that we're monitoring. Now, turning to the economy, we obviously had a big decline in second quarter. There's anticipated to be a big rise in the third quarter, sort of a bounce in recovery. And this chart reminds us that the consumer is super important, as we always discuss. And page 29 reminds us of the things, some of which we've already talked about, like what's the mindset and sort of experience for the consumer. So when we look at things like confidence, as mentioned, it is at a low level for the reasons we talked about. Retail sales, as mentioned, they're recovering, but they're just not quite back to the level we would expect. But again, 2.6% growth year over year for the month of August is pretty good. Jobless claims, fortunately that monthly number has been declining, but it's still pretty high relative to history. And then, of course, that translates to still a very elevated unemployment rate, much better than from where we came, but still a high number. So everybody's watching employment to see how it goes. Now, we included this month this Fed monitoring chart. In normal times, we're looking at inflation and other measures, but I really included this mostly to look at that GDP Now model. So this is a model out of the Atlanta Fed, basically using data to try to forecast what GDP is running at. And basically what we see is a number above 30%, crazy big, and that is reflective of the idea that we should see a big recovery in the third quarter. In fact, when we look at forecast in general, especially for the third quarter, forecasts for the second half of 2020 and for all of 2020 have been going up a little bit. And so the numbers you can see in that, and these are annualized numbers, basically in that third quarter are very elevated to make up for and recover from second quarter and a little bit from first quarter. Another sort of interesting note is that 3.7%, that decline of 3.7, the bottom of the page, that's the Federal Reserve, and they just recently sort of updated their forecast, and that number is almost, not quite, but almost 2 percentage points better than what they thought a while back. So they're seeing this recovery as well. Now let's turn to the markets. Obviously, the economy has an influence on the markets. We're reminded on page 33 of the pattern of the market, that we have bull markets and bear markets. We just came through, some could argue, the shortest bear market in history. And so we're obviously watching to see if that holds and the markets continue to recover. And then this page 34 basically reminds us of the pattern we've seen in 2019 and 2020. So last year, it seems so dramatic. It was all about trade, a little bit about Brexit and the Fed. This year, it's basically all about coronavirus and a little bit increasingly the election. But what we can see in 2020 was decent markets to open the year, big decline with the scare of the pandemic, big recovery as we figured out, number one, we'd figure out how to deal with it, and number two, the potential for a vaccine. And then recently, some volatility, some negative downdraft in those results. And again, a little bit, I think, as we anticipate and move into the uncertainty of the election. Now, as it relates to recovery, a couple charts I want to show you here. This is focused mostly on earnings. We published about this back in second week of September. And the thing I would draw your attention to is that first line, the idea that we have a big decline in GDP. This is showing different recessions going back through time. And then essentially the decline in earnings and the return on the market is defined in both cases by the S&P 500. And then finally, the last two columns, the time to recovery. So what you can see here is that essentially the S&P from a total return perspective recovered in 5 months. And that is pretty darn good compared especially to the average of these different periods over history. And then a second, it's forecasted to recover in 5 quarters or 15 months, that meaning the earnings. And so that, again, is a pretty good result relative to the impact on earnings of past recessions. So again, in that case in particular, we'll see how things unfold, but that's the consensus forecast at this point. So the good news, the market is getting every day, every week healthier and healthier and recovering more. Now, the second chart we like to share for recovery here on page 36 is basically the different downdrafts in the S&P and then how much the market recovered, the index recovered in the subsequent 12 months. So again, every time you see a green bar, it means it fully recovered. And for every bar, we show how long it took to fully recover. And the good news, again, is that this most recent data point at the bottom of the page recovered in just 5 months. So that's great news. Market valuations are always in focus. And normally it's sort of captured by price earnings. So think about that. Prices remain high, earnings have gone down, so that PE ratio has basically climbed a lot, and it's certainly well above historic levels. And that is something to be mindful of and focused on. But there's one very fundamental thing shown on page 38 that makes us less worried, which is the earnings yield compared to what you can earn by buying treasury bonds, in this case, the 10-year treasury. Basically, when you look at earnings to price, that yield is much more attractive than being able to invest in bonds. So despite the fact that PE ratios are elevated, essentially stocks are, when it comes to how much you get paid for buying the stock in terms of earnings, are still very, very attractive. So we're not overly concerned about valuation levels. Now, we want to turn to our outlook briefly. So people may recall that right in the second week of July, we published a piece about our outlooks and basically our scenarios. We have 3 scenarios, a base case, bear case, and a bull case. And our point in that publication was that we think the tails are a little bit more probable. Think of it as fatter tails is the way people describe it. But it's also very binary. It could go up or could go down. It could be a bull case or a bear case. And we sort of acknowledged that this is a very unusual time. I think of it as a potential binary market where a move could go in either direction. The most extreme example is really around a vaccine. If we see a positive, solid report on a vaccine, we think the market moves higher as a result of that. In turn, if we get an announcement that things aren't working, the market will take that very hard, and we'll see a bear market move in our view if that were to happen. The general view is that the vaccine is expected. So to conclude, I just want to remind people, especially if you get a copy, if you're watching this on YouTube or whatever, you can hit a link and see the slides themselves. But page 43 is basically just maps to our guidance. So we publish a lot, this video being one example. And as always, we want to invite you to sort of check out all the other work. And whether it's listening to podcasts or looking at our weekly note or weekly video, up to you. We just want to make sure you're aware of it and invite you to check it out. So again, thank you so much for watching this month. And we'll be back to you next month, I know, with yet another pre-election update. Thanks so much.